Corporate finance presentation, common stock valuation. Get ready, it's time to take your chance with corporate finance. Common stock valuation. Like with other financial assets that we have talked about in prior presentation, including bonds and preferred stocks, we're going to have the approach of finding the cash flows in the future and then using our present value analysis to present value those cash flows. So we're looking for the common stock, looking at future cash flows, trying to pull that back into the present value. The common stock, however, has its own difficulties, probably is the most complex because of the differences that could be taking place and assumptions that need to be made with regards to future cash flows with relation to the common stocks. Unlike the bonds, or if we think about the bonds can be a little bit complex because we have different factors involved. They could have semi-annual bonds and annual bonds on the payments, and the bonds have an annuity component and a maturity component. But once the bonds are laid out, then the information is basically on the bond. When you're talking about preferred stock, then you're talking about a situation where the dividends are a little bit more standardized and you don't have the same kind of valuation of the preferred stock beyond the dividends to the same degree that you have with the common stock due to the preferred stock not having the voting rights that the common stock will typically have, therefore the common stock being thought of as the actual ownership of the corporation due to the fact in part that they have those voting rights. So when we think about the common stock, we still have the dividends, which are going to be the type of distributions from the organization. So when we're thinking about the organization, like with the common stock, we're thinking about those future value distributions to the owners of the company, the common stockholders, will be in the form of dividends. The problem, however, is going to be the fact that the dividends could change over time, unlike the preferred stock where we can basically make an assumption that the dividends will be somewhat the same due to the preferred stocks having the dividends generally paid before the common stockholders and the amount of the dividend more set kind of in stone, whereas the common stock could depend on what the management and the board of directors want in terms of the distributions of the dividends. Dividends typically increasing as the value of the stock goes up, as the company basically gets bigger or generates more revenue. The dividends could then increase. So we have an issue there. We have the same issue that we had with the preferred stock that we don't have with the bonds, in that the dividends could, in theory, go on forever because the corporation, by being a corporation, is something that has an indefinite life. That's one of the benefits of being a corporation. And if they have an indefinite life, then the dividends would basically be going on forever as well. We also have an issue of the valuation of the company, because you might have a situation where you're thinking, well, if I sell the stock in the future, then we have a situation similar to the bond type of situation where I'm trying to think of what that future price will be that I would sell at, present value it, and present value the stream of dividends that I would have up until that point that we have the selling point. Now, if we're not selling the stock and we were imagining that we had the stock forever, then notice although the dividends could fluctuate, you might have businesses that are growing that give a very low dividend or no dividend, but you would imagine then that eventually all the money, if you were to take it out to infinity, would be distributed out in the form of dividends. That's how you would kind of think of it conceptually. Then the question is, well, how do we do that practically in terms of calculations? So the earnings of the corporation will need to be shown as cash flows. So that's going to be the bottom line of this. When we think about the earnings of the corporations, those are the things that the owners have access to at some point. Notice that if it was not incorporated and you had like a sole proprietorship or a partnership or something like that, the earnings of the corporation then, if I was a sole proprietor, if it was not a corporation, but a sole proprietorship, I can then take those earnings out at any time. They're available to me. With a corporation, that's not the same kind of situation, of course, because it being a corporation means that all the stocks and ownership shares of the shares of stock have to be standardized. One of that standardization function is that the amount of distribution in the form of dividends has to be standardized, and therefore you have to have that centralized control to determine how much the dividends will be sent out. So the earnings of the corporation then might not be distributed as dividends, but we still are thinking of them as basically something that will be distributed kind of at some point in time. We have to basically assume that the cash flow of the company or the earnings of the company can be put into cash flow in some way, shape, or form so that we can then value the company using our present value type of analysis. So we have the common stock valuation. We can imagine the present value calculation as an infinite present value of future dividends. So that's one way we could basically imagine the present value in concept. We have a similar kind of problem with the preferred stock in that we still have this kind of infinite thing, no maturity date. So we'd like to be able to simplify that kind of calculation a little bit there. And of course, the other problems that we talked about in that the dividends might not be standardized through that whole time period either. A required rate of return or discount rate would be needed for the present value analysis. Same kind of thing as with the bonds, as with the preferred stock. We need that kind of market rate, the expected rate of return, or like the discount rate that the market wants, so that we could use that for the present valuation, present value analysis of future cash flows. We can make three general assumptions related to dividends. So when we think about the dividends, we're thinking about these are the things that are going to be distributed in some way, shape, or form by the company at some point into the future. Then we can kind of categorize what type of dividends we're gonna put in place so that we can do our calculations. We can categorize either as no growth, as constant growth, or as variable growth. We'll talk about each of these in a bit more detail, but if we have a no growth calculation, meaning you might think about this as a company that's somewhat stable, meaning they have a set amount of dividends. Possibly you're talking about a company that has been established, they're not in a growth phase, and maybe they're a mature company that makes generates standard revenue, but isn't needing to really put that revenue back into the company and grow more, but rather keeps a standard pace and then can take the earnings possibly and pay them out to the shareholders. In that case, you would be thinking about a situation where the dividends are somewhat standardized. That would be similar to the calculation we have with the preferred stock, and you'd have a similar type of calculation in that instance. You could have something that has constant growth, which is probably some kind of constant growth is probably more common that people would be thinking about with stocks. Even a mature company would probably want to at least say that they're trying to grow at some point. They always want to grow, even though at some point you're gonna. In any case, you have the constant growth type of calculation, and that would be that the dividends are growing, and if the dividends are going up, that's an indication to the market that there's an increase in valuation, right? Because they're saying we plan on growing, basically revenue going up over time and whatnot, and we're going to reflect that with an increase in the dividends. Now, you could also have a situation where they're in a growth phase and they're not giving dividends out because they're putting the money back into the business. So it depends on the decisions of management, what kind of phase they're in the growth as to whether they're going to be paying dividends or not. Usually companies are going to be kind of careful to start dividends because they don't want to be in a position where they have to lower the dividends. That's usually a bad signal to the market. So usually if they start paying the dividends, you would think they're trying to taper off a slow growth on the dividends instead of, giving a really big dividend one year and then pulling it out back, the following year, which could give mixed signals to the market. But in any case, we then have the more complex situation, which is the variable growth. Now, that would be a situation where we're saying maybe they're in a growth spurt right now, and they have a higher rate of growth of the dividends. The dividends are going up at a higher rate, and then we're thinking that after that growth spurt kind of system, the dividend's not going to go back down, but they're going to continue to increase at a more moderate type of rate. And so now we have that a level up kind of dividend thing. And that's going to make our calculation a bit more complicated as well. So here's a couple ways we can just kind of generalize this. We will have practice problems, so you can take a look at these types of calculations. So first, we're going to go into the common stock valuation if there's no growth. So this is the type of company, they're giving dividends out. We're not saying that they're not earning revenue. We're saying that there's no growth in terms of the dividend growth, which would indicate that the company's somewhat stable. That could be actually good, because you might be talking about companies that are mature companies that are making good revenue, and they do what they do well, possibly, and then they pay out the excess revenue in the form of dividends, and the dividends are somewhat constant. If that were then the case, then we'd have a calculation similar to what we saw with the preferred stock. We have the same amount of dividend assumed each year, calculated like the preferred stock. So once you can imagine the situation where we could try to basically say, let's imagine these dividend payments going out to infinity, and see if we can then come up with some formula to present value what could be basically an infinite amount of payments. Obviously, the payments closer to the current period using a present value analysis would be worth more. And when you get really out into an infinite number, then the present valuing of them would make them infinitely smaller, right? As you go out. So you can think about that type of calculation to present value, or we can use our method that we did before, a little bit more simplified method here. We said the price is going to be the annual dividend. It's going to stay the same. That's going to be our assumption here with the no growth, divided by the required rate of return, which is the market rate or the discount rate. And that'll give us, and we'll do some practice problems there so you can check out the practice problems. Then we have a calculation with a common stock valuation constant growth. So now let's assume there's constant growth, meaning the dividends are going to go up at a constant rate. So they're given dividends. The dividends aren't constant in that they're not the same. They're growing, and we're assuming they're going to grow at a constant rate into the future. So in that assumption, it gets a little bit more complex for us to calculate it. So we can still imagine a present valuing of infinite series of dividend payments increasing at a constant rate. So, right, you can imagine if I'm trying to present value this, you're saying, okay, the dividends are going to go up by some percent, let's say 5% constantly we're going to assume forever. And I could try to think about a series of numbers that would go on infinitely, just like we talked about before, but with the dividends increasing at that constant rate each time. And then I would have to present value each time frame out using our present value type of calculation. So once again, that's going to be a tedious type of thing to do. You can kind of conceptually think of that, come up with a function for it, but then we want possibly a more simplified kind of calculation that would approximate the same type of concept. So the formula below is a simplified form of the calculation. The formula also works well if we assume a stock will be sold at the same point in the future. We could think about the present value of the dividends and present value of the stock price at sale. So once the formula is going to look like this, we have the price equals the dividend at end of the first year. So now we're taking the dividend at the end of the first year, dividing that by the required rate of return minus the constant dividend growth rate. So we will apply this formula too in some practice problems so you can take a look at the calculations related to them. Now note this second series, the first concept that we're talking about is the dividends are going to be paid off forever, right? Infinitely into the future, and then theoretically, all the dividends would be paid, that was generated by the company at some point in the form of dividends, assuming here in this case the constant growth, the dividends going up at a set pace. You could also have a situation where you're saying, hey, I'm going to buy this stock and I think I'm going to sell it. I'm going to sell it in like 5 years or something like that. Well, if you make that assumption, then you can kind of do this calculation a couple different ways, right? Then you have the ability to say, why don't I try to predict what the dividends are going to be for that 5-year period that I'll be receiving the dividends from, and present value those dividends that would be paid off during that time period, here assuming a constant growth of over the 5-year period, present valuing the stream of dividends, and then we'd want to figure out or estimate what the price would be for the stock at the end of that time period, which we can then calculate and figure what that price would be, and then it would be similar to a bond where we can then present value that price that we assume we're going to sell it at the end of 5 years to come to our present value analysis. Note that we'll do this with a practice problem. We have a practice problem where we kind of compare that calculation to this calculation here, and once again you'll get to a similar kind of present value component. So you could try both methods. The method where you try to kind of predict the amount of payments out into the future and then predict the price seems a little bit more intuitive to me, right? That's what you might try to actually attempt to do, when you're first trying to think about it. And then you could kind of prove to yourself that this formula usually comes out to approximately the same calculation if these assumptions are still met. So again, working practice problems is worth doing, and we do have practice problems related to these. So then we have the common stock valuation. What about a situation where we have the variable growth? This is going to be the most complex type of situation. We're going to say now we've got dividends. We're imagining the dividends go out forever, but we have this hyper growth period. We're imagining the dividends are going to go up at a higher rate for some portion of time, and we're saying we can't see that growth rate happening forever. But the fact that the company is having this massive growth in dividends would indicate that they're not planning on decreasing the dividends. That's a good signal. What we would probably assume is the dividends are going to be going up at an accelerated rate and then possibly level out at some point in time, not going down. They're still going to increase most likely, but increase basically at a more fixed type of rate. So we can have a situation where the dividends are going up at an increasing rate if you were to graph it, and then possibly going up still after that point, but at a more steady kind of rate. So in that case, we would have to kind of figure those two points out and think about when that's going to happen, when we think the growth rate's going to end, and then figure the two and present value, the two components, and then add them together. So if we have a firm with a period of exceptional growth, we can present value the dividends during this period. So we can then think about that period of time where we have that kind of larger growth period and try to present value that component, and then determine the price of the stock at the end of the exceptional growth period by present valuing the normal or constant dividends that will follow this growth period. So then we can try to present value using the constant kind of method, the present value using the constant method after that larger growth period. Then we can discount the price to the present period using the present value method, and then we add the present value of the exceptional growth dividends and the discounted price. And that's how we can basically try to get to one of these more complex type of situations where we have uneven kind of growth within the dividends. We have to make some assumptions in order to do that type of calculation.